In 2008, the global economy faced a hidden crisis. Harmless cracks soon became massive fault lines.
The answer begins with a simple dream: owning a home. But that dream became a nightmare.
In the early 2000s, banks believed real estate was the safest possible investment. They believed prices would always rise, creating a self-reinforcing cycle. But this confidence became overconfidence.
As the housing boom accelerated, banks lowered their standards, loosening their requirements to keep mortgage volume growing. But beneath it all was exploding with six building.
We are accepting offers until 5. Let me know if you have any questions.
Banks stopped holding mortgages themselves. They bundled thousands of loans into mortgage-backed securities. This process mixed safe loans with high-risk ones, making the true danger completely invisible. The pipeline begins with subprime borrowers. Local banks quickly sold these loans. Wall Street bundled them into massive safe investments, fueling a global buying frenzy.
Investors saw a perfect market, but reality was a massive bubble, filled with toxic subprime mortgages, where risk was densely concentrated, waiting to collapse.
Good news, you're all approved.
Thank you, I appreciate it.
Around 2006, housing prices began to slow. Then prices started falling and defaults rose. This triggered the massive financial crisis.
Suddenly, homeowners owed more than their homes were worth. Mass defaults cascaded, and panic started spreading. Investment bank Lehman Brothers files for bankruptcy. Banks face huge losses and stop trusting each other. Credit becomes difficult to obtain. The crisis spreads across the globe.
What began as a banking failure became a global financial crisis.
The effects of the financial crisis far beyond Wall Street. Millions of people lost their jobs as businesses shut their doors. Countless families lost their homes to foreclosure disaster.
The 2008 financial crisis was not caused by a single event. It was the result of several dangerous factors coming together: easy lending, risky mortgages, complex financial products, excessive borrowing, and a widespread belief that housing prices could never fall. When that belief proved false, the system began to unravel. Banks failed, markets crashed, and millions of people paid the price. The crisis changed financial regulations, government policies, and the way investors think about risk. Even today, economists continue to study what happened, because understanding the mistakes of 2008 may help prevent the next financial crisis. And that makes its lessons just as important now as they were then.